Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's program, we do a bit of speed dating with our regular guests, Jun Bei Liu, Julia Lee, and poor Rickard. And we've got Mike Gable coming along to look at the charts for these interesting companies. What are the companies? They are Appen, A2Milk, Nuix, South 32, AGL, Vicinity Centres, and Fortescue. So let's kick off the show right now with Julia Lee of Berman Invest, and we engage in a bit of speed dating with some pretty well-known companies. Well, first up is Julia Lee of Berman Invest, and Julia, I'm just sort of describing this a bit like speed dating, so I tossed a whole bunch of stocks at you. So let's rip on through them. Welcome to the program, by the way.
Thanks, Pete.
Okay, this one I've tossed at you a number of times. It had a pretty good week last week, but it's had a shocking year, I guess, or half year, and that's Appen. What do you think's going on there? And is it going to be a buy at some stage along the line?
Yeah, look, I've been avoiding Appen. If you look at what it does in terms of its business model, it's in data annotation. So when you have a look at things like artificial intelligence, the data has to be cleaned and labeled, and that's really what Appen looks at. It is quite people intensive, which is why it's got such a large workforce. And its top 5 clients make up more than 80% of revenue, which is a positive as well as a negative. A positive when things are going well, but when things aren't going well, or you lose a customer or you're losing business, then it's a big chunk of revenue. And that's the problem at the moment. I think Facebook is its biggest customer, and we know that Facebook has been doing a few different things. Number one, they've been looking at automated annotation models, and whether or not that's eating into revenue at the moment is we don't know, but it could in terms of future years. So looking at the technological advances in that space. And then the other thing is that Facebook has been under pressure because it has been looking at those congressional testimonies where they have been looking at consumer harm. And that means Facebook has slowed down its development of new products. Now, we don't know whether or not that impacts on Appen, but it could. So look, I still think there's a few risks there. If it loses, big customers or revenue from big customers, it can always pick up smaller customers. The only problem with that is that it costs more to acquire smaller customers, so there would be a larger marketing spend. So just watching that marketing spend and the cost of acquiring new customers and that revenue growth, and just watching to see whether we are seeing a structural shift in the market that Appen operates.
Okay, let's go to the next one. A2Milk had a good week last week, despite the fact there was talk about a class action. What's your latest take on A2?
Oh my goodness, how quickly things move. Usually when it comes to a turnaround, you have a bit of time to make some decisions, but with A2Milk, it was pretty much 2 days and you just saw the price shooting up around about 20%. The catalyst for that was a Bubs update, BUB. Bubs came out with a very positive update, and in particular, that Daigou channel to China was very strong. And of course, that means it does look like we've reached an inflection point in terms of that Daigou channel, which is an important high margin channel into China. So expectations are that we have seen revenue bottoming out in the 3rd quarter of the year, and that it will be bigger and brighter days here. The shares have already rallied around about 20% from that Bubs update. So watching for an update from A2Milk, because of course they are concentrating more on the direct channel into China rather than the indirect channel like the Daigous. But as borders reopened, you still expect that sales would come back. So, the concern here was that China is really refocusing in on its domestic brands, but that update from Bubs was an extremely positive one. So looking pretty good here. The risks are still there, but look, the share price has been so quick, it would have been hard to get on this one early.
Yeah. So the Daigou would just be cream on the business.
Yeah, China is really the strong growth channel for A2Milk, as we know. So, that's the reason why it's struggled over the last few years. And look, China has its own problems. The birth rate over in China has plummeted. So they are trying to get the birth rate up, and that refocusing in on the domestic brands. But now we are seeing borders reopening and travelers moving around. It will be interesting to see how much growth and how quickly growth comes back. I suspect A2Milk won't get back to the bullish days of a few years ago, but it does look like recovery from the very pessimistic situation that we saw when travelers weren't moving around.
Okay, let's go to Nuix now.
Yeah, I mean, Nuix is one that's fallen off the radar a little bit because it's not in the ASX 200 index anymore. If we have a look at what it does, it's really analytics and intelligence software and software as a service that it looks at. And I guess if you have a look at Nuix, it still has a way to go to build investor confidence in the stock. And I think the key thing that you're looking for here is revenue growth. And we're really yet to see revenue growth coming back. But that would be a signal for me that it's a lower risk turning point for the stock. So we've seen a bit of a recovery from the lows, but look, with interest rates still rising, we have seen that tech space coming under pressure. And I suspect Nuix is growing, but probably very slowly at this stage. So just watching for that revenue growth to come back. Some of the factors that might change my mind around Nuix and make me a bit more bullish and positive towards the stock was if we were to see a price rise in terms of the products that it has, or whether it was to find new uses for the software it has, or bolt-on acquisitions as well. So they would be positives. But at the moment, the number one thing I'm watching for Nuix before I'd be jumping on is for revenue growth to come back.
Okay. Company that's done well, but really for the last year, is South32. Do you think the upside's still there for this company?
Yeah, I think South32 is going to continue to do well to the end of the year. When it comes to commodities, you have to really look at the underlying plays. And it's been aluminium that's seen that turnaround in South32 share price. Now, the reason why aluminium has been so strong in terms of pricing is because of China. China's been having problems with electricity and blackouts in particular, and it's a net exporter of aluminium. So with those blackouts, and of course, aluminium is very energy intensive to produce, we're seeing prices rising throughout the rest of the world because there hasn't been as much supply coming out of China. So the aluminium picture is very positive for South32, and then adding that coal prices because the energy problems have been rising as well. So we have seen South32 in an earnings upgrade, and that's going to continue as long as those energy prices keep on rising. And look, I don't think China is going to sort out its electricity problem before the end of the year because we're coming into winter, which is peak usage. So just watching to see how bad those electricity problems are from China. And that's probably going to have a flow-on effect, not only for South32, but for our mining sector here in Australia.
This is a company that's not really a Julia Lee looking company, namely AGL, but have you changed your mind on this company?
Yeah, I mean, we have seen energy prices doing really well, so wholesale energy prices should be rising as well. This is not a popular stock at the moment. Share prices are still very close to the record lows, but I have to admit it is looking interesting here, and that's because of electricity prices that have stabilized and are now rising. So having a look at AGL Energy, it's not popular because of the environmental social governance impacts of it, but the price is so low now that it's potential takeover, especially as we see recovery of that energy price. So I think the key here has been the energy price increase that we've seen, which isn't being reflected in the share price at the moment, which means a short-term opportunity there.
Yeah.
But high risk.
Yes, as I say, I can understand. And I must admit, there's so many curveballs that could happen to AGL, including government interference and whatever. It bothers me. But still, it's shown some positive signs recently. What about vicinity centres? Shopping centre businesses generally?
Well, Pete, I've only still been going to my local neighbourhood centre and it is jam-packed. I was queuing across a couple of aisles just to do my grocery shopping over the weekend. So look, I think shopping centres are seeing a huge pent-up demand coming back, but I would prefer to own the retailers rather than the landlords. And the reason for that is twofold. Number one, we are seeing bond yields rising, so interest rates rising. So as interest rates rise, those I guess the property investments become less attractive. And we saw that on the market today. We saw big moves in terms of bond yields. And the sectors which were impacted the most negatively were the property sector, the REITs, as well as the tech space. On the flip side, it was great news for the banks because as interest rates rise, they get to reprice their mortgage books and margins become fatter. So look, I'd prefer retailers, in particular, really liking Harvey Norman at the moment. It's under $4.90, which I think is an attractive price. And look, this is a reopening trade. Harvey Norman usually stocks those more expensive items that you want in the house. So usually people want to see it in store before they buy it rather than buying it online. So as we see lockdowns coming to an end, I think Harvey Norman will see pent-up demand. And of course, household budgets are in good shape and the housing market is still looking pretty strong. So look, I think this is a reopening trade. And of course, underpinning it is also a pretty strong property portfolio as well. So preferring a retailer rather than looking at a landlord at this stage.
One final one, Fortescue.
Yeah, look, Fortescue, I think in the short term is a bit hard, and that's only because of the iron ore price. We know that the steel cuts in China have been hurting, and it still looks like we have seen weak steel output from the numbers today. So we saw some numbers coming out from China today. We saw GDP numbers slowing down for the third quarter to 4.9%, which was weaker than expected, and industrial production for the month of September coming in weaker than expected at 3.1% compared to expectations of 3.8%. And it looks like steel production back to the very low rates that we saw back in February. So I think as long as those electricity problems in China persist, that's going to have an impact in terms of outputs. So it looks like in the short term, Fortescue, this is probably one that I'd be looking at in the new year after the Beijing Winter Olympics were over in February. We know that the market moves before events actually happen. So I'd probably be looking at Fortescue or having a re-look at Fortescue in December, January.
Great. Julia Lee, thanks for joining us.
Thanks, Pete.
That's Julia Lee of Berman Invest. And coming up after the break is Mike Gable from Fairmont Equities. And he'll look at the charts that look at the stocks that Julia has just been running around. Well, joining us now is Michael Gable, the founder of Fairmont Equities. And Michael's going to look at some of the stocks that look like they're turning. They've at least had a good month or so. And we just see whether there's a likely uptrend forming. Mike, thanks for joining us.
Thanks, Peter.
All right, so I've thrown a few companies at you and you've brought along the one that you think looks worth investing in. But let's kick off with the first one. A2Milk has had a shocker since July of last year, around the $20 stock, and it's tumbled into the $5 or $6 mark. But the last month's been pretty good. So what are you seeing on your charts?
Yeah, look, I think the A2Milk chart's actually fairly interesting here. I still think it's a little bit early to be buying, but it does look as though it is trying to build a base. So we've had that downtrend from the middle of last year up until about a few months ago. But what I'm trying to show on the chart at the bottom right is that instead of continuing that slide, it has started to level out. And as you mentioned, Peter, just in the last month, it's had a pretty good run. So it's found some very good buying support near $5. In my opinion, I'd like to see it back above that upper blue line. So you're looking at the mid sevens, even call it $8. And I think if it can start trading at those levels, then that would be a real positive for A2Milk. So although it is a little bit early, it is starting to show signs of, as I said, a base building, and then we just take it from there.
Yeah, I've always argued, Mike, and I think I probably started thinking this might be a good buy when it got around $10 or so, given the fact that we always thought it was a quality company. Then we were really staggered that it had 4 downgrades, and now we know Slater and Gordon are actually mounting a class action against the company. But the big problem for it, I always thought, was a part of its business is the Daigou trade. A lot of the Chinese tourists that were coming here, they weren't there. So there was always going to be, I thought when that turns around, at least there'll be one little leg up, as sort of a starting point for this company to head in the right direction. And that's probably still 6 months off before we start seeing, tourists coming back to Australia en masse. So it's still a wait and see. But to me, it looked like it was building a base, and that's exactly what your chart shows.
Yeah, exactly.
Okay, let's go to your next one now. And that is, let me just get out my little notes there. That is Appen. Now, Appen's been another disappointing company, was a great performer. It's been struggling to turn it around. Are the charts telling you anything that would give an Appen shareholder any reason for hope?
It is still a bit early for Appen. When we looked at Appen together a few months ago, at that time I thought this was also potentially building a base, and I've redrawn those horizontal blue lines to show a few months ago where it looked like it was building a base. But as with A2Milk, where I mentioned that, okay, it's building a base, but it's still a bit too early. I guess this is an example of, you know, the risks in jumping into something before it breaks out of that base, because in the case of Appen, it looked like it was building a base, but then it's failed at the end of August, and it's continued on with that downtrend. So at the moment, yeah, look, it does look like it's still sliding. It did have a fairly good week last week. Obviously, tech stocks started to make a little bit of a move again, but again with Appen, it's just, yeah, it's still a little bit too early. Again, in my opinion, I'd prefer to see it sort of at least move back into that previous range that we had a few months ago, which was sort of between that $11 to $15 region. So yeah, just we've got to keep an eye on it. I think it's too early to be jumping in.
Yeah, historically, my investing technique has always been, if you see a quality company that's really been bashed up by the market, wait till you see like a 5 or 10% rise in the share price, and make it look like it's a solid turnaround trend. Now, we're probably going to need a much bigger one, given where we were between those two blue lines. We're probably going to need to see it make a 10 to even 15% gain before we had that confidence that the worst of for this company is behind it.
Yeah, exactly. I mean, with Appen, with A2Milk, they're companies that everyone loves to hate at the moment, and it just seems like there's only bad news. So I agree with you, Peter. When I see those big moves, and it doesn't seem to make sense, because everything should be going wrong with the business, but it's making proper moves up, especially on volume, and that's telling you that you know, the smart money's potentially moving in. I think it's, yeah, we haven't seen that yet, but definitely that is a key thing to look for.
Okay, next one is a company called Vicinity. It owns a lot of shopping malls and things like that. And what are the charts telling you about this company?
I think this one's also a very interesting chart. So I like when I see a stock, chart, I like it when there's some very clear horizontal boundaries with the way it's trading. So with Vicinity Centres, we could see that over the last year, there's been clearly support around the $1.50. Whenever it goes down there, it tends to see some buying, heads higher, but then when it gets near $1.80, there's some selling. So those clearly defined boundaries just make it a better probability investment or trade when it does break out of that range. So at the moment, we've seen Vicinity have a very good run across July to August. It did come back across the month of September, but in the last few weeks, it's very quickly got back up to that $1.80 mark. So if you're interested in Vicinity, I think keep a very close eye on it. It looks like it's probably only days or even a couple of weeks away from breaching that $1.80 region. And I think if it can, you know, if it's still a bit too early, but if it can get above that $1.80 level, then that will just attract a lot more buying. And you'll also have a lot less sellers as well, because clearly up until now, the selling has come in at $1.80. If it gets through that, it means that all those sellers have done their selling, and I think it'll have a clear run back up to over $2. So this is a very good looking chart, and definitely one to keep an eye on.
And you get a feel, Michael, that this is well over $2 before the coronavirus crash. It tumbled like all shopping centres should have, given the fact that people couldn't go there. Had a nice bounce out, but you can see that the lockdowns clearly have affected this business. Clearly, people can't go to shopping centres in Sydney and Melbourne, but things are starting to change now. And the last sell-off was from what, $1.80 down to maybe $1.65. Didn't get to the $1.50. Makes you get that feeling that as the world opens up in Australia, the shopping world opens up, it's got to be good for a company like this. So it seems to me like the real world circumstances are sort of marrying in with what you're seeing technically.
Yeah, exactly. You make a good point there, Peter, with the fact that the recent pullback only went to about $1.65. So it didn't go down to $1.50 this time around, which is basically giving me the, I guess, confidence that we're probably only a few days or a couple of weeks away from it actually wanting to push through that $1.80 region.
Okay, let's go to the next one now, Michael, and that's Fortescue, FMG. And this is a company that, was really flying high until the iron ore price came off the boil, and then it went down, and it's recently had a bit of a bounce. What are you seeing in this chart?
Yeah, again, another very interesting chart. I mean, I have to admit I didn't expect the iron ore price to dip as much as that. I think it's caught everyone off guard. I mean, the iron ore price has had a couple of dips this year back in March and May, but nothing as severe as what we've seen recently. But I do think that's an oversold situation. And the interesting thing about the Fortescue chart is that down here it looks like it is very close to bouncing. So what I've done this time around with the chart is at the bottom I've got the RSI, which is the relative strength indicator. So basically it is a measure of momentum, and what we're finding with Fortescue is that the momentum has been heading higher while the share price has been heading lower. It's something called divergence. So to get into the nitty gritty, if we have a look at the month of August, I've circled up the top where the price was in August, which was around $20. And then at the bottom on the RSI, I've circled where it bottomed. So as we could see, since that point, since the circles, as we move to the right-hand side, the share price has continued to head down, but the momentum has actually trended up. So what we've got there is divergence. So the share price heads lower, but momentum's been heading up that whole time. And this is, for those with very good memories, this is something I pointed out in March last year when we were looking at the broader market and how it was very close to bouncing, because for the last couple of weeks of that COVID sell-off, the market was heading down, but the momentum indicators were already trending higher. So that's what we're seeing with Fortescue. Basically, at the end of the day, what I'm trying to say is Fortescue looks like it's very close to bouncing here. So I think we've got a good low in Fortescue. And if you believe that the recent decline in iron ore is mostly over and the demand will start to kick back in, then I think these are good levels for Fortescue. And it's the same with BHP and Rio. They're all displaying similar characteristics. So I think down here, we're not getting that bounce yet. If you want to be, I guess, a little bit more conservative or a little bit more sure, you could wait for a bit more of a bounce in Fortescue to show that it's at its lows. But when I look at the chart, I'm getting pretty confident this is a good low in Fortescue.
Yeah, it seems to me if you wait another 5 or 10, there still will be plenty of upside above it.
Yeah, 100%. That's right. There's so much potential upside there that if you miss the first dollar, to be certain, then you're still making a good return.
Yeah, one of my best calls ever, Mike, was around 2015 when BHP got to about $14. I remember saying to, I think it was Michael McCarthy from CMC Markets on my old Sky Business program, that, well, like if this thing can get to $20 over the next 3 years, making $6 on 14 doesn't look too bad. And but I didn't have the guts to get in until $16, but it still was a pretty good play.
Exactly. Yep.
Let's go to your selection now, Linus. This is one you mentioned before, and I know myself, Managed Super Fund, has been a beneficiary of believing in Linus. What are you seeing now for this company?
It does look like it wants to head higher. I'll just before I talk about Linus, I'll just make a quick comment about the index, because the last couple of times we've spoken, Peter, I've spoken about the index and how it's looked a bit vulnerable. There's been a number of risks out there in the broader market. But over the past week, my reading is that there seems to be good support here. So I think that 5% pullback that we've seen over August, September, is probably it this time around. So the broader index does look pretty well supported now, and I think that generally, it should head higher. So stocks like this are now presenting as opportunities. So Linus, we spoke about this one I think in June, July, where it, as you could see on that chart, that narrowing range. I spoke about the breakout. It's had a bit of a rally, but the last several weeks have just been a wild ride for Linus. But essentially, we've got some very clear support levels down here, just above sort of $6, and there's that resistance level, that upper line, and it's bounced off that support level. So I think for the short term, we're going to see a recovery in Linus back to its recent peak, just over, just under $8. And again, if you can break that upper line, then that'll bring in new buying, and then you'll have even further upside. So I'm still quite bullish on commodities in general. I think there's still a nice tailwind for that sector, and and Linus being in rare earths, the largest rare earths producer outside of China, it looks like it's on the way back up.
Yeah, and Mike, it really is positioned for the new world of technical products that require that kind of input, isn't it? Yeah,
exactly. Yeah, definitely.
Okay. Well, Mike, thanks for joining us on the program, and we'll talk to you in a few weeks' time.
Thanks, Peter.
Mike Gable from Fairmont Equities. Well, joining me now is Jun Bei Liu of Tribeca Alpha Plus. Good to see you, Jun Bei Liu.
Great to see you, Peter. Or just say really looking forward to seeing you in real person soon.
Yeah. Can't wait to get back in the office. You and me are probably, you and I are probably two of the few people in the world who really want to get back to the office.
Absolutely. And what's funny is that I was talking to our CEO the other day. It is so rare for people to say that we're dying to get back to work.
I have noticed that people who've been at home with their dear little children are desperate to get back to the real world of adults.
Oh, absolutely. That's right. And then so instead of rushing in between, lunches and morning teas, we can kind of get back to the normal working environment. It'll be quite exciting.
It'll be exciting. Okay, I've asked you to look at a number of stocks, and these stocks here, some of them I've noticed that at least over the last week, some of them over the last month, they've started to show some upside. A number of them have been clobbered, and I guess it could be a bit of wishful thinking in there as well, because I'm holding some of these stocks as well. I'd be interested to see what you're thinking about these companies. Let's kick off with one that a lot of people are rooting for on the sidelines, and that's Appen, APX. What do you think?
Yeah, look, I think the Appen share price has fallen a lot, and it perhaps has found its bottom now. The talk is there will be potentially another small downgrade, not going to be a big one because they have downgraded many times. I think, but the small downgrade potentially is still there, potentially coming in November. However, the share price has fallen so much. Appen is no longer an expensive stock. I think ultimately, this company has gone through the disruptions by the COVID and the like, and its earning hopefully should really have found the bottom by now. And next year, if anything, the earnings should accelerate, in terms of performance compared to what they experienced this year. So, it's actually making it looking very interesting at this share price.
Yeah, I had Mike Gable on earlier talking about the stock, and he says it looks like it's forming a base, but he says it's probably not the right time exactly now. He said, but it might not be too far off.
People are saying that that's one thing that often people say, look, the downgrade is never priced in. Look at so many companies that keep downgrading, they keep falling. But the share price has fallen so significantly. And we expect the downgrade perhaps from 0 to 5%. So that is not that dramatic. And it certainly seems like with the share price fall, people are expecting much bigger downgrade. I think, based on the business momentum we've seen so far in the results, some things are improving, and some of the issues that has been impacted by the COVID should hopefully to improve. I think certainly looks interesting. You should definitely keep this one in watch.
Okay, now one that used to be a favorite and was a terrific stock, A2Milk, last month, well, even last week, I think it was up 13%, wasn't it? Despite the fact there was talk about class actions and everything.
That's right.
What's your latest take on A2Milk?
Oh, I like A2Milk. So I know we've gone through likes and dislikes and everything. Look, everything has a price. So A2Milk has lost more than 60% of its value in the last 12 months. Now, ultimately, what's really changed, compared to 12 months ago was, the brand is still very, very strong, and it's still the Asian consumer love to buy its product. The problem was that because it's such a premium label company, premium label, infant formula, when pandemic first hit, all the Chinese parents just went out and stock up on all the infant formula. And then obviously when things turn out, to be not as bad as expected, people are running down their own household pantry. So that means the demand for A2 products sort of, ceased somewhat. And then at the same time, when the Daigou channel couldn't really travel to buy infant formula from here and ship it across because of the border was closed. So all of that together has meant the A2 share price has lost a lot. But our view is that, I think the share price has found its bottom. It's got an investor day coming up. I think it will point towards some positive data. We saw Bubs has reported talking to significant improvement in the Daigou channel. We think it, for A2 perhaps is smaller read-through, but still things are, pointing to the green. So with the share price where it is, very cheap, no debt, strong cash balance, it certainly put that one on the radar. We like this one.
Okay, let's go to Nuix now, NXL.
Yeah, look, honestly, I think on the speculative front, we like this one as well now. Share price has lost a lot. Look, today your list is just a basket list that we want to buy. Nuix has gone through significant issue. What has been the main problem for this company was, they have, the US election as well as the COVID. There was a lot of disruption in terms of winning new contracts. Now, this company was on the aggressive end in booking its revenue. So when the new contract was a bit delayed, it did create a bit of problem in terms of meeting its prospectus forecast. But honestly, it hasn't missed all that much. But the share price has fallen a lot, and now the CEO gone, CFO gone, it has put a lot of negative sentiment on this price. Now they just hired the CFO who was ex-Star, and then they got appointed some independent board members who are highly regarded. The next news flow will be the new CEO. So we think a lot of bad news is in the share price. Of course, when the new CEO starts, he will rebase the earnings, but based on what it's trading on at the moment, it is so much cheaper than its peers. And the share price is actually below what the previous private equity, the trade sale price was, when at the time of listing. So we do think there's an intrinsic value sitting in this company, but we've still got rocky road ahead, but the value really presents at the current price.
Okay, you're doing well, Jun Bei Liu. Let's go to South 32 now.
Look, South 32 has done very well. The share price has been incredible. Look, it's a low quality company. It's not something that you can buy and hold, but it is operating in a very, very good environment at the moment. Aluminium prices doing really well. Alumina prices doing really, really well. And coal prices doing very well. So it is owning, this company owns some of the, highly sought after priced commodity at the moment. Doesn't really hold much of a bulk like the iron ore miners, which sort of all struggled. So, it looks in a good environment. Based on the spot prices, earnings come upgrade, but I'm more of a neutral because it just does so well relative to the other commodity companies. And as we said, these are not high quality businesses. So you kind of need to, when things go well, take some profit and put into some other commodity business perhaps that's being oversold.
Here's a challenging one, AGL.
Yeah, that was too hard for me. It's been a difficult business. I think at the current share price certainly represents some value as it split out the two businesses. I was just about to sneeze. Sorry. Can I start this one again?
Yeah,
okay.
You can.
Okay. So AGL. Okay.
So
on AGL. Okay, AGL is this one is hard. Look, it is going to split out. It's the green co and then the dirty company, and and then for the green co, there will be a very good valuation. However, the amount of equity or capital, additional capital required, is still very, very hard to determine that how much capital you need to use to back the other business, one of the business. So it's still come equity raising. So it is cheap, but it's very hard to see the share price going anywhere. Perhaps it will hold its value. It will be defensive if the market falls, but it's just hard to allocate money to this business where part of its majority of its business has very limited lifespan.
Okay. What about the shopping centre business, Vicinity, VCX?
Yeah, I like the shopping center business. That they are still very, very cheap relative to other property companies such as industrial property and others. They're still trading at a big discount to what their actual asset value is. Vicinity, together with Center Group, they own some of the premium locations. If anything, we all know the property prices for residential, industrial, all gone up significantly in the last couple of years. And yet the shopping center prices haven't really done all that much because the shops were shut. Its earning will follow a great trajectory of reopening, and then we expect that valuation to its asset to close very quickly.
Okay, one final one. Fortescue Metals. All the miners have copped it. My personal view is that if 2022 is going to be a strong year for the global economy, you think the iron ore price and the iron ore share prices will go up. But what's your view?
Yeah, look, I think I agree with you. I think next year the global growth will be fairly strong. I think Fortescue has absolutely been oversold on the basis of what's happening in China. Iron ore prices, perhaps there will be more volatility to come because as the Chinese working through its issues in the property trust sector, or property developer sector. But the iron ore equities such as Fortescue has been oversold. Even compare that to the likes of Rio. Fortescue stand out, massively. We certainly think that's being oversold. It represent good buying opportunity. On the basis of that, BHP is another one, which we think, is also a very, very good buying because it also has oil assets as well. At the time when BHP got sold off 40% in the last couple of months, Woodside, which will form the future part BHP, Woodside, venture has gone up 10%. So it's an outperformance of 50%. You certainly see there's a lot of value inherent in those majors.
Jun Bei Liu, thanks for a great assessment of some interesting companies.
Thank you very much.
Well, joining us now is Paul Rickard of the Switzer Report. Thanks for joining us, Paul.
Thanks, Peter.
All right, so you've got a special bit of reconnaissance into all the stocks out there that you like, but you've actually narrowed it down to one really important stock that you think everybody should have in their portfolio. I guess if your children or grandchildren said to you, what stock should I buy first of all? What should be in my portfolio? This is the one. Is that right?
Yeah, I mean, it's a bit more than that, Peter, but it came from a reader question. Basically, what's the one core stock in your portfolio you really want to have? And while I'd never recommend just one stock, because I'm a great believer in diversification, and all the studies show that diversification in a strategy works, it's nevertheless an interesting question just to try to narrow it down to one. So I just looked at the top 20 stocks, Peter, because I think that's probably more than enough, and went through it on a sector-by-sector basis. Of the banks, clearly for me, it's Commonwealth Bank and Macquarie. I've written for many years about how Commonwealth Bank is head and shoulders ahead of the other major banks. Macquarie is a very different sort of banking business, much an investment bank, much more offshore, but it's certainly looked after shareholders over the long term. In terms of the resources companies, BHP, Rio, Fortescue, Woodside, I think you're really going to go for BHP, Peter, simply because it's probably the best diversified and has the best assets. And then you look at companies like CSL, obviously in the healthcare space. In the supermarkets, you've got Woolworths and Coles. I think Woolworths is the market leader and comes out comfortably in front. Wesfarmers gets up there because it's really done really well as a conglomerate. It's probably the last in that model. And the last sort of shortlist contender, I guess, is Goodman Group. which is not just done really well post the pandemic, Peter, but this industrial property group, which is pretty much a global business now with most of its revenue outside Australia, has also been one of those companies that's got a great 10-year stock picture. So on a shortlist basis, I come down to CBA, Macquarie, CSL, Wesfarmers, Woolworths, and Goodman Group.
Well, it's a good group of stocks, Paul. Now, as you're talking, I had a quick look to see what the analysts think about Goodman Group, and they've got about 15 to 16% upside. A lot of those companies you mentioned aren't going to have that kind of potential upside, at least in the short term, like Goodman Group. So what have you come up with?
Well, look, I went back for the trust and old faithful CSL, Peter. You know, I've been a CSL fan since day dot. I missed investing in the privatisation of the old Commonwealth Serum Laboratories when investors paid an effective 77 cents per share. It's now trading at just under $300. So I wasn't smart enough back in 1992, but I still think CSL is there for long term, and it's a stock, that hopefully my grandchildren will be able to enjoy one day, Peter, because the thing to like about CSL is it's really a fact its function is 3 reasons. First of all, it is the global leader in its field of blood plasma products, right? There's no one other company that's close. And it's number 2 globally in terms of influenza vaccines. So in its field, it's either number 1 or number 2 on a global basis. And I think that's got to be something to recommend about a company. Yep. Secondly, year in, year out, Peter, it's been able to grow. It's had this amazing ability to under-deliver and overperform. That is, comes up with a number, a forecast, provides a bit of guidance, and then we find out it is half-year or full-year results. It's usually at the upper end or over the guidance range. So a terrific delivery record. Doesn't say a lot between reporting periods, but it's been super reliable. And that's, I think, a great testament to the management of the business and leadership. And then thirdly, I just like healthcare, Peter, because it still has a lot of really strong industry tailwinds. Now, they may not affect CSL as much, but they do affect the whole industry in the sense that, it's very much supported by the governments around the globe, invest a lot of money in healthcare, so that provides a great level of demand support. Secondly, we all know the population in the Western economies is aging, and as people get older, they need more health services. And thirdly, not only do they need more health services, but because of the advances in technology, we all go and get health services, so many more times than did our parents or grandparents or any generation that came before them. So our demand for health services is also increasing. And so all those sort of tailwinds help to support what CSL does. So it's primarily about the company, but I do like the industry tailwinds behind it. So that's why I've come down with CSL.
Okay, so if you had to move away from that particular one, obviously you've done some thinking on Goodman Group, and I must admit I've liked the company. I've got a small exposure to it because I could see it was going to benefit from the fact that a lockdown has expedited people's interest in buying online. And when you buy online, the stuff is stored in warehouses. Invariably, Goodman Group is supplying those warehouses. So, and I think the online world is just going to get bigger and bigger and bigger. So that has to be good for Goodman Group. What is your take on this company, Paul? Has it gone up too high because we've gone mad on online buying in the short term and it might go off the boil? Or do you think the long-term connection between normal people buying online and warehousing is going to be something that will get bigger and bigger?
Look, I think it's going to get bigger, Peter, and Goodman Group is far more than that. It just specialises in terms of what it looks after in terms of investment, as a funds manager or as a manager of property or as a developer, more in the industrial part of the market. And it's a global business, Peter. In fact, I think Australian revenue is only about 30% of the business. So it really has done well offshore, particularly in Asia. I went back, conscious of the fact that it's done so well post the pandemic, because we know that, the shift to online got a super drive when, the virus hit and people moved their shopping behaviour to online. I went back and had a look at his 10-year chart, Peter, and you'll find that over 10 years, it's been largely sort of pretty much uphill the whole way. That is a very, very positive trend over more than a decade. In fact, it's gone up by more than 5 times over the last decade in price, and paid some interesting dividends. So while I think it might just need to pull back a little bit from where it is, because as the world goes back to normalcy, some of the that sort of shift will slow down a little bit. It's a stock that I'd be looking at in any pullback to be seriously on the buy list.
Yeah, and I can remember during the GFC, it was absolutely clobbered, but once again, it rebounded pretty strongly. And of course, the GFC was a longer recession period than the last one, which was the shortest recession I've ever come across, shortest, the deepest I've ever come across. But if ever there was a serious recession, it would suffer because the businesses that are its tenants would have troubles. But yeah, it's the kind of stock you buy in a serious sell-off, that's for sure.
Yeah, I mean, I think Goodman Group, Macquarie at the right price. Obviously, Peter, it's just gone gangbusters the last couple of months or last month or so. Was another one, and Wesfarmers also. It's probably not as glamorous as the others, but Wesfarmers again for shareholders has provided a pretty good long-term return. It's shown itself pretty agile at sort of being able to flick its portfolio around. It's got out of the mining and the resources. It's into things like lithium. It's sort of its new investment wave in sort of post Bunnings and post Officeworks and post Kmart. And it's been pretty disciplined in terms about how it approaches investments. So a conglomerate, yep, but delivered a pretty good return for shareholders over the long term. And I think Wesfarmers can also keep on doing it.
And I've got a sneaking suspicion, correct me if I'm wrong, but I think it's actually, its share price has fallen enough to make it at least interesting for someone who wants to hold it for the long term.
Yeah, look, I tipped it to go to 60. It got to about $65. I'm not sure why. It fell back to sort of the mid-50s. And if you're looking for any stock that's there's no reason why it's in the mid-50s now and was in the mid-60s a couple of months ago, apart from just a bit of profit taking. There's probably a bit of value in Wesfarmers.
Okay, Paul, thanks for joining us.
Thanks, Peter.
And that was Paul Rickard of the Switzer Report. And if you want to try the 21-day free trial of the Switzer Report to get more in-depth analysis about the stocks that we like, go to switzerreport.com.au. That's the show for tonight. Thanks for joining us. I'll see you on Thursday. I'm Peter Switzer. I'll see you then.